It's Friday, April 24th. I'm Brian Walsh, and welcome to This Week in Impact, where I talk with ImpactAlpha journalists and editors about some of the most interesting impact investing stories we've been covering. This week, I'm joined by editor David Bank. We'll discuss a Ugandan pension fund readies a $100 million fund of funds to create jobs and future savers. Plus, with shared ownership, KKR's $4.8 billion exit of CoolIT gives workers a cut of AI-driven gains. And finally, after 12 years, advisory firm Align Impact will shut down at the end of this month. That's all coming up on This Week in Impact. Hi, David. How are you doing this week?
I'm doing fine, Brian. It's been climate week out here in San Francisco, so we've been running around town, and it's been exciting to have everybody come to San Francisco.
Indeed, and speaking of travel, I was in Philly last weekend for the finals of the Turner Mint, the MBA Impact Investing Network and Training, and met some ImpactAlpha subscribers and some This Week in Impact listeners. So hello to all of you.
Yeah, the spring event season is in full swing, and it's great to see everybody out and about.
All right, first up, local institutional capital in Africa is stepping up to fill the void left by retreating foreign development assistance. Ari Luciangigi wrote about Uganda's National Social Security Fund, which manages $7 billion in assets, and how it's carving out 1% of that for impact investments, starting with anchoring a $100 million fund of funds. David, what makes this story so compelling?
Yeah, this is part of something we've been tracking for a while, which is the increasing mobilization of local capital, as in African pension funds, insurance funds, even high net worth African individuals to fund sustainable development and job growth in Africa. And the pullback of foreign aid is one driver, of course, but also it's part of a broader kind of rotation of capital into domestic economies from domestic sources. So the National Social Security Fund is a pension fund in Africa, and they've taken the lead on this for a very interesting reason, which is that the more jobs that can be created, the more savers in the pension scheme. And that's very important as kind of the demographics change in Africa, and there's more older people pulling down pensions. You need more younger people contributing to the pensions. And so they had the very smart idea of like, let's help create some jobs that will be both a good investment for the fund to make from their endowment, from their corpus, and also provide future savers for the fund itself.
So a nice self-reinforcing thesis right there. But let's talk about what's sometimes called the hourglass dilemma, where you have large institutional pools of capital that are a poor fit for the small deal sizes that tend to dominate the African market. So how does this try to take a crack at that challenge?
Yeah, well, there's kind of people sometimes think of capillaries or sort of just the way that capital can flow. And these large institutional investors, and it's not just African ones, it's any big pension fund, big sovereign wealth fund, they need to write large checks. They have a lot of money to put to work. There's transaction costs for each deal. They're frankly not that much less for a small deal, so they'd rather do big deals. Now, most of the enterprises in Africa and other emerging markets can't accept those kinds of checks. So they have to go through these intermediaries, namely fund managers and other kinds of capital providers. And even many of those are very small, by the measure of these large funds. So the fund of funds structure has turned out to be the way that you can put big money to work and have it flow first through local capital providers, local fund managers who know their local conditions, the local entrepreneurs, understand the markets, and then flow ultimately to these enterprises that don't need big checks, but do need reliable and accessible capital to grow and, like I said, to create jobs.
So, David, usually when we have a new structure like this, it's usually started by an entrepreneurial fund manager who then tries to sell that structure to LPs. But this is a case of an LP creating the structure and then trying to look for managers to help fill that structure out.
Yeah, and that's exactly what is so significant here. We've been tracking another fund of funds in Ghana called Chigaba, and they've raised $30 million, but they've been at it for quite a while, and it's very hard road to hoe. They did get a number of Ghanaian pension funds to come in there, but as you said, it was started from the manager looking to raise the capital, and that's a typical pathway. And in Uganda, the LP, the asset allocator, the asset owner itself, has essentially stood up this fund, and they're going to bring in other LPs LPs. So they're going to put up something like 15 or 20 million of what's projected to be 100 million. And they're going to try to bring in other pension funds, other investors, and get it up to 100 million. There'll be a manager that's selected, and then that will go out to these local capital providers and other fund managers in smaller chunks. But it, like you say, it's driven by the LP who has the money in the first place. It makes the whole thing move much more quickly and much more smoothly.
And this isn't happening in isolation. You mentioned Zambia, but there are other examples in Africa too. So tell us about Rwanda, what's happening there.
Yeah, Brian, as I said, there are a number of efforts to mobilize local capital for what the three-letter acronym is SMEs, small and medium enterprises, sometimes SGBs, small and growing businesses. And then one we like is growth enterprises, which kind of puts the emphasis on growth in the sense of these are not just, the shop at the corner. These are growing businesses, serving large and growing markets. And so Rwanda's Social Security Board launched something called the SME Growth Fund with $30 million. Zambia's National Pension Scheme, with some international development finance institutions, launched a similar fund with $70 million in its first close, aiming for $300 million. And then also in Uganda, the East African Development Bank and the Development Bank of Rwanda and some other development and microfinance institutions launched a $36 million fund to provide loans for something like 500 small and growing businesses. The difference, though, is that many of those funds are going direct to the enterprises, and they're not going through these intermediaries. They're not, strictly speaking, funds of funds, and so they don't necessarily solve this hourglass dilemma that we talked about, although they are bringing capital to the marketplace. And so the importance of this sort of intermediary level is that there's then a sort of capacity among local investment firms and fund managers, again, that can understand the local markets, that can push money out, that can work with the enterprises. If you do this all at the top level, you're maybe pushing money out, but you're not giving that kind of hand holding and technical assistance and kind of market building mechanisms. So there's a few different trends here that come together: local capital, but also kind of this fund of funds capillary system to stand up a local ecosystem.
All right, it sounds like the beginning of a trend that we'll continue to watch here at ImpactAlpha. A lot of exciting stuff. All right, you can read Lucy's full piece on Uganda's National Social Security Fund on ImpactAlpha.com. There's also a link in our show notes. Later on, one of the earliest purpose-built impact advisory firms is shutting its doors. We'll discuss what it means for the field. But for now, we'll take a quick break. When we come back, what KKR's successful exit of a liquid cooling company for AI data centers portends for employee ownership.
Hi there, Agent of Impact. This is Dennis Price, CEO of ImpactAlpha. For more than a decade, ImpactAlpha has been helping you find the alpha in impact. We've now built ImpactAlpha Edge to bring you structured data and market intelligence to help you move faster, invest smarter, and multiply your impact. ImpactAlpha Edge is designed to help GPs and fund managers raise capital more effectively. LPs and allocators find each other and discover overlooked opportunities. Think of it as a purpose-built pitch book for impact, with the editorial judgment and network trust that no algorithm can replicate. Come check it out. Book a demo today. Learn more about ImpactAlpha Edge in our show notes.
Next up, a big exit shines a light on an important coverage area of ours: employee ownership. We've had several stories and guest posts on ImpactAlpha about CoolIT, a liquid cooling company for AI data centers. Last month, private equity giant KKR sold CoolIT for $4.8 billion, a 15x return in 3 years. Workers shared in the upside. 650 of them received average payouts of $240,000 each, with some longer tenured workers taking home more than 8 years of salary. So, David, this sounds like a big success story for employee ownership, but not everyone was celebrating this deal, and it's led to a genuine debate about what worker ownership can and should look like. So, David, before we get to the concerns some have had over this deal, let's start with the basics. How is this an employee ownership story?
Well, it's kind of a Rorschach test of whether it really is an employee ownership story. KKR, as we've been reporting in ImpactAlpha, is kind of the leader among the big private equity firms in doing what they call shared ownership. Sometimes it's called broad-based ownership, and it basically extends to hourly workers and more or less everybody in the firm some of the payout when the private equity company exits. And in the case of KKR, it's generally been about 3.5%. Now, in the CoolIT case, the 3.5%, as you said, turned out to be quite a big number because the $4.8 billion sale price total was eye-popping, but it was still 3.5%. And the kind of standard for what the employee ownership crowd thinks of as true ownership is at least 30%, even better, 100%. So on those standards, it doesn't really measure up. Now, it's important to remember that from the point of view of the worker who got, as you said, $240,000, that is a very meaningful, sum. In many cases, much more than a year or even two of salary. And so it's nothing to sneeze at from those workers' point of view. The question really is if KKR and the other private equity folks can share 3.5% and feel that is additive to the value, employees have more better morale and higher retention and sort of more incentive to help build the value, then why not share more? Why isn't that 3.5% 5 or 10 or 15 or 20 or 30% or really 100%? How far can this employee ownership model go to really redistribute, or as we like to say, pre-distribute the gains from the value created, in many cases by those workers.
Right. So this is a debate that gets at the heart of criticisms around capitalism, about what share of proceeds go to labor, what shares go to capital. So let's walk through some of the criticisms of this approach.
Yeah, it's really kind of a theory of change debate, I think, ultimately. And where I come down, frankly, is that the 3.5% is clearly not adequate or certainly not, the end goal, but we're at least discussing how much to share with workers, not whether to share anything at all. And so my kind of take is always go from win to win, get your foot in the door and then keep, prying that door wider and wider. There are folks who think that it's, sort of a disservice to, even accept, that the 3.5% even counts as ownership. It's really more like, it's not quite a profit sharing because it's not profits we're talking about. It's the exit valuation, but it's similar in that it's, it's a small bonus, or in this case, a large bonus, but nonetheless, it's not, there's no governance rights associated with it. There's, in fact, the employee ownership plan kind of ended with the purchase, and so it doesn't go forward. So there's lots of reasons to criticize this kind of limited private equity model, but that's all the reason to improve that model and to expand it, as many of the employee ownership buyout funds that we like to cover are doing. And so we had another post this week from Aner Ben Ami at Candide. They've done a lot of investing in employee ownership, and he came down saying, that the CoolIT deal would never really have been in the sights of these 30% or 100% buyout funds. It was bought at such a high multiple of its revenues that you would have had to load it up with so much debt to service the loan that financed the employee transition that you would have sunk the company. And so there's a kind of zone where these larger employee buyouts make sense, where the purchase price, just to get technical, is more like 6 times EBITDA or 6 times profits, and that the CoolIT was more like 16 times profits. And so therefore, it would have been too rich, too expensive for these employee ownership buyout funds to finance. So, and his point is there's plenty of these kind of middle market companies that are very much well suited to employee ownership to work on before we have to worry about the very small number of much bigger firms that are getting this kind of more, let's say, dilute ownership treatment.
So it sounds like, David, that some people would say, well, this is a nice deal for the employees of CoolIT, but it's not a true employee ownership story. And that the true employee ownership story is something else. And it's better that KKR gave this amount that they did to these employees, but let's not sing their praises and calling this like an employee ownership story.
Yeah, and that's a bit of semantics, a bit of theory of change, a bit of ideology in there. As you said, the CoolIT employees received about $240,000. The typical ESOP after 7 to 10 years is about $80,000. So you could have a 100% employee ownership that would pay out much less than this 3.5%, which is frankly a function of the sort of astronomical exit price of the $4.8 billion, which itself is a function of this kind of AI boom. And so while it's a good debate to have, this is a little bit of an odd case to make the object lesson in the sense that those employees really did get quite a rich payday.
That's why I appreciated Anthony Bug-Levine's piece in Impact Alpha, talking about firms that are really looking at the financing gap. That's the true story here in the employee ownership beat. So tell us about the cases that he was making.
Well, it's just that there's need for much more financing to finance these buyouts. I mean, the way these things work, just very simply, is that a loan is made to buy the company on behalf of the employees, and then that loan is repaid from the profits of the company itself. And so there's a need for financing to make those loans. It's been hard because the banks don't, generally speaking, like to make loans to a whole group of employees. They like to have one person they can go collect from. And so these buyout funds, people know APIS and Heritage, and there's now a handful of others that are financing these buyouts. And like I said, they're focused on quite a different part of the market than the KKRs. They, generally speaking, don't go head to head, but there's no reason why they can't move up market and start being more relevant in these larger deals as well. And so as that whole market develops and as employee ownership becomes kind of more of a mainstream tool, in particular as a lot of these aging baby boomers start retiring and exiting from their businesses, there's plenty of room for employee ownership to grow.
All right. Well, you can read our full coverage of CoolIT, along with the outside voices criticizing the deal, on ImpactAlpha.com. There's also links in our show notes. For now, we're going to take one more quick break. When we come back, Align Impact and what happens when one of the first impact advisory firms closes shop. Finally, this week, David, you had the exclusive news that Align Impact, one of the first firms built from the ground up around impact advisory, is shutting down at the end of this month after 12 years in business. Tell us more about what you've learned here and what are the implications for the impact investing field?
Yeah, this story was a kind of a bitter pill to swallow because ImpactAlpha and Align got started right around the same time. And I remember chatting with Jennifer Kenning when we were both getting going and kind of linking arms as we leaned into this new field. And she built Align Impact to be one of the leading registered investment advisors, as they're called, helping foundations and families and others find impact investments and build their portfolios. And she built it up to about $743 million in assets, according to their SEC filing. But it was always a tough road to hoe. They had a few different businesses, including consulting, a number of funds, and they did sort of third-party work for other advisors. But the pieces didn't necessarily fit together, and apparently it wasn't a money-making operation. They did raise a bit of money at the end of 2024, but by last year they were kind of out of money, and they explored a sale of all or parts of the business. They couldn't find a buyer, and so they will be shutting their doors at the end of April.
All right. So what's happening to some of their clients and to the team as well?
Well, they sent a letter to the clients resigning as their advisor. I gave them 30 days notice at the end of March. Frankly, that's how we heard about the story. Some of those folks let us know that this was happening. And those clients, are finding other advisors, and I think Align is in its final weeks, helping them do so. And then much of the team, about half dozen folks, are moving to Sorensen Impact Advisory, which is the advisory arm of the Sorensen Impact Group. And I should just say here that Sorensen Impact Foundation, another part of that same group, is an investor in ImpactAlpha. There's another irony too, is another part of that group, the Sorensen Impact Institute at the University of Utah, is running a $1 million collaboration fund, as we've reported, to help nonprofits find consolidation and collaboration opportunities. So there's a little bit of irony, or perhaps it's fitting, that Sorensen Impact Advisory itself is playing a role in kind of consolidating a bit of the field.
Now, Align Impact, David, you mentioned, had over $700 million in assets under management, yet it still couldn't reach profitability. So what does that tell us about the economics of impact advisory at this kind of sub $1 billion scale?
Yeah, I mean, it sounds like a lot of money, of course, but in the world of advisory, it's not that much. You get fees on the assets under management. You get different set of fees for what's called assets under advisory, and then these other businesses have their own fee schedules, and so you're putting together quite a complicated business, which needs a lot of expertise and obviously then people. And so it's very hard to make it go at that level, and which is why there's been a sort of consolidation in that field. We've seen Cornerstone go to Pathstone. We've seen Weatherby merge. Imprint, of course, got bought early on by Goldman Sachs. And there's always just a need to get bigger and bigger, and sometimes that dilutes the impact focus because the larger firms are not as committed to that. But it's hard to get to critical mass now. Matthew Weatherly-White, who took over as CEO of Align Impact last year, told us that he was afraid that this was going to kind of tar the impact field as somehow, not viable. And he told us, quote, "I can say unambiguously that the failure of Align has nothing to do with our impact investing focus."
Well, time will tell that whether this is just a one-off about Align Impact or whether there's a broader shakeout in the impact investing advisory business.
Yeah, what's the Warren Buffett line about when the tide goes out, you can see who was swimming naked?
All right, that sounds like a good place to end it. You can read David's story on Align Impact at ImpactAlpha.com. There's also a link in our show notes. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thanks, Brian.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the impact advisory firm Human Nature. We'll see you next week for more Impact.